Hello, I'm Jared Friedman from Redwood Financial Planning, and today I'm going to discuss tax loss harvesting, a useful investing/tax move to counteract capital gains. Even though this may end up being a subpar year for stocks, you still may realize capital gains, which is a taxable event. What can you do about them? You can do what some investors do. You could recognize investments with a loss and practice tax loss harvesting. Keep in mind though, this video is for informational purposes only. It's not a replacement for real life advice, so make sure to consult your tax, legal, and accounting professionals before modifying your investment strategy. Selling losers to offset winners. Tax loss harvesting means taking capital losses. You sell securities worth less than what you paid for them to help offset the capital gains you may have already recognized. Keep in mind that the return and principal value of your stocks or bonds will fluctuate as market conditions change, and past performance is no guarantee of future returns. While this doesn't get rid of your losses, it can be an approach to manage your tax liability, the tax savings potential. Sure, you can use this technique to put your net gains at zero, but that's just a start, because up to $3,000 of capital losses in excess of capital gains can be deducted annually, and any remaining capital losses above that can be carried forward to potentially offset capital gains next year. But remember, tax rules are constantly changing, and there's no guarantee that the treatment of capital gains and losses will remain the same. So, by taking losses this year and carrying over the excess losses into the next, you could potentially offset some or maybe all of your capital gains next year. This strategy in action is really quite simple. Step one is to pick out the losers in your portfolio. Step two, you have to decide which losers you're actually going to sell. And step three is giving the green light to those transactions. Now, your portfolio may reflect your time horizon, risk tolerance, and investing goals. So before moving ahead with a trade, it's important to understand the role each investment plays in your portfolio. Now, you must watch out for the IRS's wash sale rule. However, you can't claim a loss on a security if you buy the same or substantially identical security within 30 days before or after the sale. In other words, you can't just sell a security to rack up a capital loss and then buy it back real fast. Now, your investment professional should be able to illustrate how a wash sale works. Watch the fine print on wash sales. The wash sale rule applies to your entire taxable portfolio, not just one taxable account within it. So, for an example, if you sell an individual holding or a stock in one company, you must wait for the wash sale window to close before you can purchase the shares of the same firm. Also, the wash sale rule applies to multiple taxable accounts, and it's worth remembering if you're married and file your taxes jointly. Here are some minor drawbacks to tax loss harvesting. It's important to stress that you may not wish to alter a carefully chosen portfolio simply for tax loss harvesting, especially if it has been built for the long term. You also can only practice tax loss harvesting in taxable accounts. Tax advantage retirement accounts are ineligible for this strategy. Also, transaction costs can add up, so think about those costs versus the overall strategy and tax savings before you begin. Bear in mind, this is not just a year-end tactic, but a year-round strategy. Some investors harvest losses throughout the year, not just in December, and you may want to ask the financial professional in your life how you can take advantage of it today. I hope you found this video helpful. If you don't want to miss out on any future videos, please subscribe to our channel below. Thanks and have a great day.